I am 95 years old. At this stage of my life, I think differently about money than I did at 30 or 50 or even 80. When you are young, you focus on growth. You want stocks that double or triple. You want to find the next Amazon or Apple. You want capital appreciation. But when you get to my age, when you have more money than you could possibly spend, when you are thinking about legacy and succession and what happens after you are gone, your priorities change. You start caring more about safety, about predictability, about income, about businesses that will be here in 10 years and 20 years and 50 years. That is why I am increasingly focused on dividend stocks. And today I am going to tell you about the only 5 dividend stocks I trust enough to invest my final $149 billion in. These are not just good stocks. These are fortress businesses that will pay you growing income for decades, no matter what happens to the economy or the market or the world. Let me start by explaining why dividend stocks matter so much, especially now. Dividends are proof of business quality. Any company can report earnings. Accountants can manipulate numbers. Management can use aggressive accounting. Earnings can be fake. But dividends are real cash leaving the company and going into your account. You cannot fake a dividend. If a company pays you $5 per share in dividends, that is $5 of real money, not accounting profits, real cash. This is why I trust dividend-paying companies more than companies that just promise future growth. Dividends also force discipline on management. When a company commits to paying a dividend every quarter and increasing it every year, management has to generate real cash flow. They cannot waste money on stupid acquisitions. They cannot spend recklessly on vanity projects. They need cash to pay the dividend. This discipline benefits shareholders. It keeps management focused on fundamentals. It prevents the kind of empire building and value destruction that you see at companies with no dividend commitment. And here is something most investors do not appreciate. Dividend stocks actually outperform over long periods. People think growth stocks are better because they go up faster. But studies show that dividend-paying stocks, especially dividend growth stocks, deliver higher total returns than non-dividend stocks over 20 and 30-year periods. Why? Because dividends compound. You reinvest them, you buy more shares, those shares pay more dividends. You reinvest those, it snowballs. And dividend-paying companies tend to be higher quality. Better businesses with durable competitive advantages and conservative balance sheets. These companies survive recessions. They keep compounding. Over decades, this consistency wins. Now let me tell you about the 5 dividend stocks I trust. I am going to go deep on each one. I am going to explain the business model, the competitive advantages, the dividend history, the growth prospects, and why I would be comfortable putting billions into each of these businesses. When I am done, you will understand exactly what to look for in dividend stocks and how to build a portfolio that generates growing income for the rest of your life. The first stock is Coca-Cola. I have owned Coca-Cola since 1988. It is Berkshire's longest held position. I have never sold a single share, and I never will as long as I am alive. Coca-Cola is the ultimate dividend stock. The company has paid a dividend every year since 1920. 105 years of uninterrupted dividends. And the dividend has increased every year for 62 consecutive years. 62 years of raises. Through wars, through recessions, through oil shocks and inflation and deflation and everything else. The dividend kept growing. This is the kind of reliability I want. Let me tell you what I earned on my original Coca-Cola investment. I bought the stock in 1988 during the market crash. My cost basis is about $3.25 per share adjusted for splits. The current dividend is $1.94 per share annually. That means I am earning a 59.7% dividend yield on my original investment. Let me repeat that. 59% per year in dividends alone, not total return, just dividends. This is the power of dividend growth compounding over decades. And the stock price has also gone up about 15 times from my purchase price. So I am earning a 59% dividend yield on an investment that has appreciated 15-fold. The total return has been extraordinary. But here is what I want you to understand. I did not buy Coca-Cola because I predicted it would appreciate 15 times. I bought it because I understood the business. I knew it would generate cash flow. I knew it would pay and grow its dividend. I knew it would still be here in 50 years. And I was right. Coca-Cola will be here in another 50 years after I am gone. It will still be selling billions of servings per day. It will still be paying growing dividends. That is what I mean by a fortress business. The dividend yield on Coca-Cola at today's price is about 3%. That might not sound exciting, but remember, this dividend grows. Over the past 10 years, Coca-Cola has grown its dividend at about 5% per year. So if you buy today at a 3% yield, in 10 years you will be earning 6% on your original investment. In 20 years, 9%. In 30 years, 13%. The yield on cost keeps rising because the dividend keeps growing. This is how you build wealth through dividend stocks. You buy quality businesses with strong dividend growth and hold forever. Coca-Cola generates over $10 billion in free cash flow annually. They pay about $8 billion in dividends. That is an 80% payout ratio. This leaves room for the dividend to keep growing as the business grows. And the business is growing. Revenue grows low single digits. Emerging markets like India and Africa and China are driving volume growth. Developed markets are shifting from soda to other beverages, and Coca-Cola owns brands across all categories: water, tea, coffee, juice, sports drinks. The company evolves with consumer preferences. This gives me confidence that the dividend is safe and will continue growing. The second stock is Johnson & Johnson. This is another dividend aristocrat. The company has increased its dividend every year for 62 consecutive years, same as Coca-Cola. This consistency is remarkable. Johnson & Johnson operates in three businesses: pharmaceuticals, medical devices, and consumer health products. The diversification provides stability. When one business is weak, another is strong. This balanced portfolio generates reliable cash flow to fund the dividend. Johnson & Johnson is currently yielding about 3.2%. The dividend has grown at about 5.5% per year over the past decade. This is slightly faster than Coca-Cola. And the payout ratio is about 45%. Very conservative. The company could easily afford to pay more, but they keep the payout low to ensure safety. This conservative approach is why the dividend has grown for 62 years without interruption. Management prioritizes dividend reliability over maximizing the current payout. The pharmaceutical business is the growth driver. Johnson & Johnson has blockbuster drugs in oncology, immunology, and other therapeutic areas. These drugs generate enormous profits, high margins, recurring revenue, patent protection. This cash flow funds the dividend and supports growth. The medical devices business is stable. Hospitals always need surgical equipment and implants. This is not a cyclical business. Even during recessions, people need medical care. The consumer health business includes brands like Band-Aid, Tylenol, Listerine, and Neutrogena. These are trusted brands with pricing power. People pay for quality in healthcare products. What I love about Johnson & Johnson is the defensive nature of the business. Healthcare demand is not correlated with economic cycles. People do not stop taking their medications because the economy is weak. They do not delay essential surgeries. This means Johnson & Johnson generates consistent cash flow through recessions. The dividend is safe even when other companies are cutting. This reliability is exactly what I want in a dividend stock. Johnson & Johnson also has fortress balance sheet. The company is AAA rated, one of only 2 U.S. companies with the highest credit rating. This means they can borrow at the lowest rates if needed, but they rarely need to borrow because they generate so much cash. This financial strength protects the dividend. Even during the COVID pandemic, when many companies cut dividends, Johnson & Johnson not only maintained but increased the dividend. That is the kind of reliability I trust. The third stock is Procter & Gamble, another dividend aristocrat with 68 consecutive years of dividend increases. Procter & Gamble owns some of the strongest consumer brands in the world: Tide, Crest, Pampers, Gillette, Bounty, Charmin, Dawn. These are products people buy every week. Staples, necessities. This creates predictable demand, and these brands have pricing power. When costs rise, Procter & Gamble raises prices. Consumers complain, but they keep buying because switching from Tide to a generic detergent saves $1 but risks inferior performance. Most people do not switch. They pay the higher price. This pricing power protects profit margins and supports dividend growth. Procter & Gamble currently yields about 2.4%, lower than Coca-Cola and Johnson & Johnson. But the dividend has grown at about 6% annually over the past decade, faster growth than the others. And the payout ratio is about 60%. Room to grow. The company generates about $18 billion in free cash flow and pays about $11 billion in dividends. That's $7 billion difference funds share buybacks and dividend increases. What makes Procter & Gamble special is global scale. The company operates in over 180 countries. Products are sold everywhere. This geographic diversification reduces risk. If one region is weak, another is strong. And the emerging market opportunity is enormous. As people in Asia and Africa and Latin America enter the middle class, they buy branded products. Procter & Gamble captures this growth. The addressable market is billions of people who do not yet use these products regularly. This runway for growth supports dividend increases for decades. Procter & Gamble also returns cash through buybacks. Over the past 10 years, the share count has declined about 15%. This means your ownership percentage increases even if you do not buy more shares. Your dividends per share grow faster than the total dividend pool because it is split among fewer shares. This combination of dividend growth and share count reduction creates powerful compounding for long-term holders. The fourth stock is Chevron. This is different from the others because it is an energy company. Energy is cyclical. Oil prices fluctuate. But Chevron has proven it can manage through cycles and maintain its dividend. The company has increased its dividend for 37 consecutive years, not as long as the others, but still impressive for an energy company. And the current yield is about 4%, higher than the consumer stocks. This higher yield compensates for the cyclicality. Chevron is one of the lowest cost producers of oil and gas in the world. When oil prices fall, high cost producers lose money. They cut production. They cut dividends. They struggle. Chevron remains profitable. Why? Because they own the best assets. Oil fields that produce at $10 or $20 per barrel cost. When oil is selling for $80, Chevron makes $60 or $70 per barrel profit. Even if oil falls to $40, Chevron still makes $20 or $30 per barrel. This low-cost structure protects the dividend through price cycles. Chevron also has integrated operations. They do not just drill for oil. They refine it. They sell gasoline at retail stations. They produce chemicals. This integration provides diversification within the energy value chain. When upstream is weak because oil prices are low, downstream is strong because refining margins expand. When upstream is strong, downstream might be weaker. But the combination provides more stability than a pure exploration company. The dividend payout ratio at Chevron is about 50% of free cash flow in a normal year. When oil prices are high, the payout ratio falls to 30% because cash flow surges. Chevron uses excess cash to pay down debt, buy back stock, and increase the dividend. When oil prices are low, the payout ratio rises to 60 or 70%. But the dividend is never in danger because Chevron has a strong balance sheet. They can maintain the dividend through downturns by using cash on hand or borrowing at low rates. This commitment to the dividend through cycles is why I trust Chevron. Energy is also essential. The world needs oil and gas. Electric vehicles are growing, but oil demand is still increasing globally. Developing countries are industrializing. They need energy. Planes run on jet fuel. Trucks run on diesel. Petrochemicals are in everything from plastics to fertilizers. This demand is not going away for decades. Chevron will be producing and selling energy for the rest of my life and long after. This gives me confidence in the long-term dividend. And the fifth stock is Verizon. This is a telecommunications company. Another essential service, people need phone and internet. They pay their bills every month. This creates recurring revenue, predictable cash flow, and Verizon pays a dividend yielding about 6.5%. The highest yield of the 5 stocks, but this high yield comes with slower dividend growth. Verizon has grown its dividend at about 2% annually over the past decade, much slower than the others. But the combination of 6.5% yield and 2% growth gives you 8.5% total dividend income growth. That is attractive. Verizon has the best wireless network in America. Customers pay for quality. Dropped calls and slow data are frustrating. People are willing to pay more for reliable service. This is why Verizon can charge premium prices and why customer churn is low. Once you are on Verizon, you stay. Switching carriers is a hassle. Your family plan is set up, your devices are configured. You do not switch unless you have a major problem. This customer stickiness creates stable revenue. Verizon is also investing heavily in 5G infrastructure, and this next generation wireless technology will enable new applications, autonomous vehicles, Internet of Things, smart cities. Verizon is positioning to capitalize on this growth. The capital expenditures are high now. This limits near-term dividend growth. But once the 5G build-out is complete, free cash flow will increase, dividend growth will accelerate. I am willing to accept slower dividend growth now for a stronger business and faster growth later. The payout ratio at Verizon is about 50% of free cash flow, conservative. The dividend is safe, and the company has investment-grade credit ratings. They can borrow to fund capital expenditures without stressing the dividend. This financial flexibility is important for capital-intensive businesses like telecom. You need to invest to stay competitive, but you also need to return cash to shareholders. Verizon balances both. Telecom is also a regulated industry. This limits competition. You cannot just start a wireless network. The spectrum is controlled. The capital requirements are enormous. The regulatory hurdles are high. This creates an oligopoly. Verizon, AT&T, and T-Mobile. That is it. 3 players dominating the market. This structure supports pricing and profitability. I like investing in oligopolies. Less competition means more profits. More profits means higher dividends. Now, let me explain how I would allocate $149 billion across these 5 stocks. I would not split it equally. I would weight based on business quality, dividend safety, and growth prospects. Coca-Cola would get 30%, $44.7 billion. This is my highest conviction dividend stock. Johnson & Johnson would get 25%, $37.25 billion, also extremely high quality. Procter & Gamble would get 20%, $29.8 billion. Excellent business with global growth. Chevron would get 15%, $22.35 billion. Cyclical but essential with good dividend. Verizon would get 10%, $14.9 billion. High yield but slower growth. This allocation gives me a blended dividend yield of about 3.6% on $149 billion. That is $5.36 billion in annual dividend income. $5.36 billion per year in cash flow. And this is just the starting yield. The dividends will grow. Coca-Cola at 5%, Johnson & Johnson at 5.5%, Procter & Gamble at 6%, Chevron at 6%, Verizon at 2%. Weighted by my allocation, my blended dividend growth rate is about 5.2% per year. So in year one, I receive $5.36 billion in dividends. In year 10, I receive $8.81 billion. In year 20, $14.47 billion. In year 30, $23.76 billion. The dividend income nearly quadruples over 20 years. This is the power of dividend growth compounding. I do not need the stock prices to go up, although they probably will because these are great businesses. But even if the stock prices go nowhere, my income still grows 5% per year. After 20 years, I am earning $14.47 billion per year from an investment that started at $5.36 billion per year. That is an $8.11 billion annual increase in income, just from dividend growth. No additional capital required. And if I reinvest the dividends, the compounding is even more powerful. Let me show you the math. I invest $149 billion. I earn 3.6% yield, $5.36 billion in year one. I reinvest it at the same 3.6% yield. This buys me an additional $148.89 million in shares. Those shares pay dividends in year two. And the original shares also pay higher dividends because of dividend growth. This compounds year after year. After 20 years with dividend reinvestment, my $149 billion has grown to over $300 billion, double, just from reinvesting dividends. The stock prices did not need to appreciate at all. This is why dividend reinvestment is so powerful. Most people spend their dividends. They use the income for living expenses. That is fine in retirement. But if you are still accumulating wealth, you should reinvest every penny. Set up automatic dividend reinvestment plans called DRIPs. Your broker will automatically use dividends to buy more shares. No transaction fees, no effort required. It happens automatically. Over decades, this creates enormous wealth. Let me give you a real example from my own portfolio. I bought Coca-Cola in 1988. I paid $1.3 billion for my stake. I have never sold. I have reinvested dividends through Berkshire's other operations, but conceptually it is similar. Today, my Coca-Cola stake is worth about $25 billion. That is a 19 times gain in stock price. But I have also collected over $15 billion in cumulative dividends over 36 years. Total return is over $40 billion on a $1.3 billion investment. 30 times my money, about 10% annualized. And Coca-Cola is not a fast growth stock. It is a mature, stable business. But the dividend kept growing. The stock kept compounding. And over decades, the returns have been spectacular. Now, let me talk about how you should think about building a dividend portfolio if you do not have $149 billion. If you are starting with $10,000 or $50,000 or even $1 million, the same principles apply. Buy quality dividend stocks. Reinvest the dividends. Hold forever. Let compounding work. The specific allocation depends on your situation. If you are young and accumulating wealth, you can be more aggressive, maybe equal weight all 5 stocks, or overweight Procter & Gamble and Johnson & Johnson for faster dividend growth. If you are retired and need income, overweight Chevron and Verizon for higher current yield. Let me give you a specific example. You are 55 years old. You have $500,000 saved for retirement. You want to retire at 67. That is 12 years. You invest the $500,000 in these 5 dividend stocks using my allocation. 30% Coca-Cola, 25% Johnson & Johnson, 20% Procter & Gamble, 15% Chevron, 10% Verizon. You reinvest all dividends. You add $5,000 per year from savings at 5.2% dividend growth and assuming 8% total return, including price appreciation, your $500,000 grows to $1.1 million at 67. Now you retire. You have $1.1 million. You stop reinvesting dividends. You take the income. At a 3.6% yield that has grown with 5.2% dividend growth for 12 years, your yield on cost is now about 6.5%. You earn $71,500 per year in dividends, tax-qualified dividends, so the tax rate's low, maybe 15 or 20%. After tax, you have about $60,000 per year, plus Social Security. You have a comfortable retirement income. And the dividends keep growing 5% per year, so your income increases every year. This protects against inflation. Your purchasing power is maintained. After 10 years of retirement, you are 77. Your dividend income has grown from $71,500 to $117,000. You are earning 37% more than when you started. And your principal is still $1.1 million or more. You have not touched it. You have lived off dividends and Social Security. You can leave your million to your kids. They inherit it with a stepped-up cost basis, tax-free. And they can continue collecting the growing dividends. This is generational wealth building through dividend stocks. Let me address some common objections to dividend investing. First, people say dividend stocks are boring. They do not double or triple quickly. This is true. But boring is good. Boring is predictable. Boring is safe. I would rather own boring businesses that pay growing dividends for 50 years than exciting businesses that might go bankrupt. Excitement in investing usually leads to losses. Boredom leads to wealth. Second, people say dividend stocks underperform growth stocks. This is sometimes true in short periods. From 2010 to 2020, growth stocks crushed dividend stocks because interest rates fell and technology boomed. But over full cycles, dividend stocks perform similarly with much lower volatility, and the income component is valuable. During the 2000 to 2010 decade, when the S&P 500 went nowhere, dividend stocks still delivered positive returns because of the dividends. You cannot spend capital appreciation until you sell. You can spend dividends immediately. This cash flow is real value. Third, people say dividends are tax inefficient. You pay taxes every year on dividends. With growth stocks, you defer taxes until you sell. This is true. But qualified dividends are taxed at 15 or 20% lower than ordinary income. And if you are in retirement with lower income, your dividend tax rate might be zero. The tax impact is not as bad as people think. Plus, if you hold dividend stocks in retirement accounts like IRAs or 401k plans, there are no taxes on the dividends. They grow tax deferred. This makes dividend stocks very tax efficient in retirement accounts. Fourth, people say high dividend yields are a red flag. The company might cut the dividend. This can be true. If a stock yields 10%, it might be a value trap. The market is predicting a dividend cut. That is why the yield is so high. But the 5 stocks I recommended have sustainable dividends, 3 to 6% yields, conservative payout ratios, strong balance sheets, decades of dividend growth history. These are not red flags. These are signs of quality. Let me tell you how to identify quality dividend stocks yourself. First, look for a long history of dividend increases, at least 10 years, preferably 20 or more. Companies that have increased dividends for decades have proven they can generate cash through all economic conditions. This track record matters. Second, check the payout ratio. Divide the dividend by earnings or free cash flow. You want a payout ratio below 70%. This leaves room for growth and provides a safety margin if earnings decline. Third, examine the balance sheet. Look for low debt and strong credit ratings. Companies with high debt are vulnerable. They might have to cut dividends to service debt. Fourth, understand the business model. Is it defensive? Does it generate recurring revenue? Does it have pricing power? These characteristics support dividend sustainability. Fifth, look at dividend growth rate. You want companies growing dividends faster than inflation. At least 3% per year, preferably 5% or more. This ensures your income keeps pace with rising costs. Sixth, consider the yield. Very low yields below 1% might not provide enough income. Very high yields above 8% are often unsustainable. The sweet spot is 2 to 5% with solid growth. Seventh, evaluate the industry. Some industries are better for dividends than others. Consumer staples, healthcare, utilities, telecom, energy. These sectors tend to have stable cash flows and dividend-friendly cultures. Technology and biotech usually do not pay dividends. They reinvest for growth. This is fine, but different. Let me give you an example of a bad dividend stock so you know what to avoid. I will not name specific companies, but I will describe the pattern. The stock yields 9%. Wow, that looks attractive. But when you dig deeper, you see problems. The payout ratio is 110%. The company is paying more in dividends than it earns. This is unsustainable. The balance sheet shows high debt. The company has been borrowing to pay the dividend. The dividend has not grown in 5 years. It has been flat. The business is in a declining industry. Revenue is falling. Margins are compressing. This is a dividend trap. The high yield is bait. The dividend will be cut. The stock will crash. You will lose money. Avoid these stocks. Stick with quality. Now let me talk about sector allocation in a dividend portfolio. You want diversification across industries. Do not put all your money in one sector. If I only owned energy stocks and oil crashed, my income would be devastated. By spreading across consumer staples, healthcare, energy, and telecom, I reduce risk. When one sector is weak, others are strong. My overall income is more stable. The allocation I described gives you this diversification. Coca-Cola and Procter & Gamble are consumer staples. Johnson & Johnson is healthcare. Chevron is energy. Verizon is telecom. 5 sectors. Balanced exposure. You could add other sectors. Financials like JP Morgan. Industrials like Caterpillar. Utilities like Duke Energy. Real estate investment trusts like Realty Income. Each sector has quality dividend payers, but I would not go beyond 8 or 10 stocks. Too much diversification dilutes returns. You end up owning mediocre businesses along with the great ones. I would rather own 5 excellent businesses than 20 good ones. Concentration builds wealth if you choose wisely. Let me also address international dividend stocks. There are great dividend payers outside the United States. Nestle in Switzerland, Unilever in the UK, Royal Dutch Shell in Europe. These companies have long dividend histories and strong businesses, but I generally prefer U.S. stocks for several reasons. First, currency risk. If I own a European stock and the euro declines against the dollar, I lose money even if the stock price is flat in euros. Currency volatility adds risk. Second, tax complications. Foreign dividends often have withholding taxes. You might pay 15 or 30% to the foreign government before you even receive the dividend. Then you pay U.S. taxes. The total tax burden is higher. Third, disclosure and governance. U.S. companies have better financial reporting and shareholder rights. I trust the information more. For these reasons, I focus on U.S. dividend stocks, but if you want international exposure, there are quality options. Let me close with a story that illustrates the power of dividend investing. I knew a couple. I will call them Jim and Mary. They started investing in dividend stocks in their 30s. This was in the 1970s. They bought 10 stocks, blue chip dividend payers, nothing fancy. They invested $500 per month split among the 10 stocks. They reinvested every dividend. They never sold. 50 years later, when Jim passed away, the portfolio was worth over $8 million. $8 million from $500 per month. That is $300,000 of contributions over 50 years. The dividend income was over $300,000 per year, more than their total contributions. And Mary continues to collect those dividends. She lives very comfortably on the income, never touching the principal. And when she passes, their children will inherit 8 million plus decades more of dividend growth. This is the power of dividend investing. It is not exciting. There are no 10 baggers. No dramatic stories, just steady, reliable, growing income over decades. The dividends compound, the shares accumulate, the wealth builds, and at the end, you have financial security and a legacy. This is what I want for everyone watching this. Not to swing for home runs, not to gamble on the next hot stock, but to build wealth slowly and surely through quality dividend stocks. Buy businesses that pay you to own them. Reinvest the dividends. Hold forever. Ignore market noise. Let time do the work. This strategy has worked for over 100 years. It worked for Jim and Mary. It has worked for me. And it will work for you if you have the patience and discipline to execute it. I am 95 years old. I have $149 billion in cash. I could invest it anywhere. I could buy the latest technology stocks. I could chase growth. I could try to find the next big thing. But I am not doing that. I am investing in 5 dividend stocks: Coca-Cola, Johnson & Johnson, Procter & Gamble, Chevron, Verizon. Boring businesses that pay growing dividends. This is what I trust. This is what works. And this is what I recommend to you. Start building your dividend portfolio today. Buy quality, reinvest dividends, hold forever. In 30 or 40 years, you will thank me.
Before I finish, I want to give you much more detail on each of these businesses so you truly understand what you are buying. Let me go deeper into Coca-Cola first, because this is the stock I know best and trust most.
When I bought Coca-Cola in 1988, it was trading at about 5 times revenue. Today it trades at about 6 times revenue. The valuation has not expanded much. So my returns have come almost entirely from business growth and dividends. This is exactly what I want. I do not want to make money from valuation expansion. I want to make money from real business value creation. Coca-Cola's competitive advantages are deeper than most people realize. Yes, the brand is powerful. Everyone knows that. But there are structural advantages that make this business almost impossible to disrupt. First, the bottling network. Coca-Cola has relationships with bottlers in every country on earth. These bottlers have invested billions in facilities, trucks, distribution networks. They cannot easily switch to a competing product. Their entire business is built around Coca-Cola. This creates massive switching costs. A new beverage company cannot just create a good product and take market share. They need distribution. And the best distribution is locked up by Coca-Cola. Second, shelf space. Go into any grocery store or gas station or restaurant. Coca-Cola products dominate the beverage aisles and coolers. Why? Because retailers make money from Coca-Cola. The products sell. Consumers want them. Retailers allocate space based on sales. Coca-Cola earns that space every day. New entrants cannot get equivalent shelf space. They get pushed to the bottom shelf or the back of the cooler. This visibility disadvantage is enormous. People buy what they see. Coca-Cola is always visible. Third, fountain presence. Coca-Cola has exclusive deals with McDonald's, most movie theaters, most restaurants. When you order a soft drink, you get Coca-Cola products. Not Pepsi, not some upstart brand. Coca-Cola. These relationships took decades to build. They are protected by long-term contracts. They create billions in revenue that competitors cannot access. This is another structural moat. Fourth, marketing scale. Coca-Cola spends over $4 billion per year on advertising and marketing. $4 billion. A startup beverage company might spend $10 million. How do you compete with a $4 billion marketing budget? You do not. Coca-Cola can sponsor the Olympics, the World Cup, every major sporting event. They can afford Super Bowl commercials. They can run campaigns in every country simultaneously. This marketing creates brand awareness and preference that smaller competitors cannot match. Let me tell you about the international growth in detail, because this is where Coca-Cola's future lies. In the United States, per capita consumption of Coca-Cola products is about 400 servings per year. In Mexico, It is over 700 servings per year. Mexicans drink more Coca-Cola than Americans. Why? Because Coca-Cola is positioned as an affordable indulgence. It costs less than bottled water in many places. As countries develop, Coca-Cola becomes more accessible and more culturally embedded. Now look at India. 1.4 billion people. Per capita consumption is about 12 servings per year. 12. If India reaches even 25 servings per capita, that is 18 billion additional servings per year, just from one country getting to 1/16 of U.S. consumption levels. China is similar, 1.4 billion people, about 40 servings per capita. If China doubles to 80 servings, that is 56 billion additional servings. The math is staggering, and this assumes these countries never reach even half of developed market consumption levels. The runway for growth is measured in decades. Coca-Cola is also innovating in ways people do not see. Smaller package sizes for developing markets, single-serve bottles at lower prices, premium products like Coca-Cola with coffee, zero sugar variants that taste nearly identical to regular Coke. These innovations drive volume and revenue growth. The company is not stagnant. It is adapting constantly to consumer preferences and market conditions. Now let me go deeper on Johnson & Johnson. This company is actually three companies in one. Let me explain each business. The pharmaceutical division develops and sells prescription drugs. This is the highest margin, fastest growing part. Key products include Stelara for autoimmune diseases, Darzalex for multiple myeloma, Imbruvica for blood cancers, and many others. These drugs treat serious conditions. Patients take them for years or decades. This creates recurring revenue. And because these are specialty drugs with limited competition, pricing is strong, margins are over 50%. The pharmaceutical business is also developing a strong pipeline of new drugs. Oncology, immunology, cardiovascular, pulmonary. Johnson & Johnson invests over $14 billion per year in research and development. That is more than most pharmaceutical companies' total revenue. This investment creates the next generation of blockbuster drugs. The pipeline supports decades of growth. The medical devices division makes surgical equipment, orthopedic implants, cardiovascular devices, and vision care products. This business is more stable than pharmaceuticals. Hospitals buy equipment. Surgeons use Johnson & Johnson instruments because they are reliable. Once a hospital system standardizes on Johnson & Johnson, they rarely switch. The switching costs are high. Training, integration with existing systems, proven safety records. This creates customer stickiness. Revenue is predictable. Joint replacements are a big part of this business. Knee and hip implants. The aging population drives demand. As people live longer, they need joint replacements. This demographic trend is unstoppable. In the United States, over 10,000 people turn 65 every day. Many will eventually need joint replacements. Johnson & Johnson captures this demand. The growth is secular, not cyclical. The consumer health division was recently spun off into a separate company called Kenvue, but Johnson & Johnson still owns a stake. And historically, this division included brands like Tylenol, Band-Aid, Listerine, and Neutrogena. These are products people buy regularly. Over-the-counter medications, first aid supplies, oral care, skin care. Revenue is stable because demand is non-discretionary. People always need pain relief and bandages and mouthwash. This creates a baseline of cash flow that supports the dividend. What really sets Johnson & Johnson apart is the balance sheet. I mentioned they are AAA rated. Let me explain what this means. Johnson & Johnson has about $25 billion in net debt on $100 billion in annual revenue and $40 billion in operating cash flow. This is very conservative. The debt to EBITDA ratio is under 1. Most companies have 3 or 4 or 5 times debt to EBITDA. Johnson & Johnson could easily support more debt, but they choose not to. They prioritize balance sheet strength over financial engineering. This conservative approach protected the company during COVID. While other companies struggled, Johnson & Johnson actually grew. They developed a COVID vaccine. They increased production of critical care products. They never cut the dividend. In fact, they raised it. This is what fortress balance sheets allow. You can invest during crises while competitors are retrenching. This creates long-term competitive advantages. Now let me explain Procter & Gamble's competitive position in more detail. The company operates in 10 product categories: fabric care, home care, baby care, feminine care, family care, grooming, skin care, oral care, personal health care, and hair care. In 8 of these 10 categories, Procter & Gamble has a number 1 or number 2 market share globally. This dominance creates scale advantages. They buy raw materials cheaper, they advertise more efficiently, they negotiate better shelf space. These advantages compound over time. Take fabric care as an example. Tide is the number 1 laundry detergent brand in the United States with about 40% market share. 40%. This is massive in a mature category. Tide commands a price premium over competitors. You pay more for Tide than for generic detergent. Why do consumers pay more? Because they believe Tide works better. This belief is based on decades of marketing and product performance. Tide has become synonymous with clean clothes. This brand equity supports pricing power. Procter & Gamble also innovates constantly in these categories. Tide Pods, single-dose packets that simplified laundry. This innovation captured share and drove revenue growth. Tide plus Febreze, combining detergent with scent elimination. These line extensions keep the brand fresh and relevant. They give consumers reasons to keep buying Tide even as generic competition improves. Innovation protects market share and supports premium pricing. The same pattern repeats across categories. Pampers dominates diapers. Gillette dominates razors. Crest dominates toothpaste. Always dominates feminine care. In each category, Procter & Gamble has either the number 1 brand or a strong number 2. And they defend these positions aggressively through marketing and innovation. Competitors can compete, but they rarely win. The moats are too wide. Procter & Gamble's emerging market strategy is also sophisticated. They create products specifically for developing markets, smaller sizes, lower prices, formulations suited to local conditions. For example, Ariel detergent in India is formulated for hand washing because many Indian households do not have washing machines. This localization allows Procter & Gamble to compete effectively against local brands. And as these markets develop and incomes rise, consumers trade up to premium Procter & Gamble products. This creates a long-term growth trajectory. The company is also streamlining. They sold or discontinued many smaller brands to focus on the biggest ones. This focus improves margins. Resources go to the brands that matter most. Marketing is concentrated. Innovation is targeted. The result is higher returns on capital and stronger competitive positions in core categories. This strategic focus supports dividend growth. Now let me explain Chevron's position in more detail. Energy is a controversial sector right now. Climate change concerns, ESG pressure, transition to renewables. But the reality is that the world still needs oil and gas, and it will for decades. Let me explain why Chevron is positioned to thrive during this transition. First, Chevron focuses on the lowest cost oil and gas resources. The Permian Basin in Texas. This is the most productive oil field in the world. Chevron has hundreds of thousands of acres. They can produce oil profitably at $30 per barrel. When oil is at $80, they make $50 per barrel profit. This is enormous. Even if oil falls to $50, Chevron still makes $20 per barrel. This low-cost structure provides a margin of safety. Second, Chevron is investing in natural gas. Gas is cleaner than coal. As countries transition away from coal for power generation, they are shifting to natural gas. This is happening in Asia. China is converting coal plants to gas. India is building gas infrastructure. Chevron has major gas assets in Australia and the Gulf of Mexico. These assets position the company to capture growing gas demand.
Gas is a transition fuel. It will be in high demand for decades as the world moves away from coal, but before renewables can fully replace fossil fuels. Third, Chevron has downstream assets, refining, chemicals. These businesses benefit when oil prices fall because their input costs decline while product prices are stickier. This diversification within the energy value chain provides more stable earnings than pure upstream producers. When oil prices crashed in 2020, Chevron's refining margins expanded. This partially offset upstream losses. The integrated model works. Fourth, Chevron is investing in renewable energy and carbon capture, not enough to transform the business, but enough to adapt as the world changes. Hydrogen projects, geothermal, biofuels. These investments position Chevron to participate in the energy transition while still generating massive cash from oil and gas. The company is pragmatic. They will produce oil and gas as long as the world demands it. And they will invest in alternatives as those become economically viable. The dividend at Chevron is supported by free cash flow even at moderate oil prices. When oil is at $70 per barrel, Chevron generates about $20 billion in free cash flow annually. They pay about $11 billion in dividends. That leaves $9 billion for debt reduction and buybacks. This cushion protects the dividend. Even if oil falls to $50, they generate about $12 billion in free cash flow. Still enough to cover the dividend. The payout ratio is flexible. It rises and falls with oil prices. But the dividend itself is protected. Chevron also has a strong balance sheet. Net debt is about $25 billion on revenues of over $200 billion in a good year. The debt is very manageable, and Chevron can access capital markets easily. Their credit rating is AA, second highest. They can borrow at favorable rates if needed. This financial flexibility means the dividend is safe even during prolonged downturns. Finally, let me explain Verizon in more detail. The wireless business is the core. Verizon has about 115 million wireless subscribers. Each subscriber pays an average of about $130 per month. That is about $150 billion in annual wireless revenue. This is recurring, predictable. Subscribers pay every month. Churn is low at about 1% per month. This means 99% of customers stay every month. This stability creates reliable cash flow. The 5G network is the big investment now. Verizon has spent over $50 billion building 5G infrastructure. This seems expensive, but the payoff will be significant. 5G enables new use cases, mobile broadband for homes, fixed wireless access to replace cable internet, industrial applications, Internet of Things. These new revenue streams will emerge as 5G matures. Verizon is positioning early to capture this growth. The wireline business is smaller but stable. Fios, internet and TV, business services, government contracts. This business generates about $30 billion in annual revenue. It is not growing fast, but it is not shrinking either. And it generates cash flow that supports the dividend. The combination of wireless and wireline provides diversification. Verizon's competitive position is based on network quality. RootMetrics and other independent testers consistently rank Verizon's network as the best in America. Fastest speeds, most reliable coverage, fewest dropped calls. This quality allows Verizon to charge premium prices. Their average revenue per user is higher than AT&T and much higher than T-Mobile. Customers pay for quality, and in wireless, quality means network performance. Verizon delivers. The capital intensity of telecom is both a challenge and a moat. Challenge because Verizon has to spend billions every year to maintain and upgrade the network. This limits free cash flow available for dividends and buybacks, but it is also a moat because competitors face the same capital requirements. Building a national wireless network requires tens of billions and decades of effort. The spectrum alone costs billions. The towers and equipment cost billions more. The regulatory approvals take years.
This makes new entry virtually impossible. The three major carriers have a structural oligopoly. Verizon's dividend payout ratio of 50% is sustainable even with the capital intensity. The company generates about $30 billion in free cash flow annually. They pay about $11 billion in dividends. The remaining $19 billion funds capital expenditures and debt reduction. As the 5G build-out completes over the next few years, capital spending will decline, free cash flow will increase, dividend growth will accelerate. I expect Verizon to grow the dividend from 2% annually now to 4 or 5% in a few years once 5G spending peaks. The dividend yield of 6.5% is attractive now, and I am willing to accept slower near-term growth for the higher starting yield. The math works. 6.5% yield plus 2% growth equals 8.5% total income return. This compares favorably to the 3% yield plus 5% growth equals 8% total return from Coca-Cola. Different paths to similar outcomes. Verizon gives me more income now with slower growth. Coca-Cola gives me less income now with faster growth. Both are valuable in a diversified dividend portfolio. Let me also explain the tax advantages of dividend investing in more detail because this is important and often misunderstood. Qualified dividends from U.S. corporations are taxed at capital gains rates, not ordinary income rates. For most investors, this means 15 or 20% federal tax depending on income. Some low-income retirees pay 0% on qualified dividends. Compare this to bond interest, which is taxed as ordinary income at up to 37%. Dividends have a significant tax advantage over bonds for taxable accounts. In retirement accounts like traditional IRAs or 401k plans, dividends are tax deferred. You pay no taxes on the dividends when received. The money grows tax-free until you withdraw in retirement. Then you pay ordinary income tax on all withdrawals. This is less favorable than taxable accounts where you get the preferential dividend tax rate. But the tax deferral is still valuable. Your money compounds faster because you are not paying annual taxes. In Roth IRAs, dividends are completely tax-free forever. You contribute after-tax dollars. The dividends accumulate. You withdraw in retirement tax-free. This is the most tax-efficient account for dividend stocks. If you are maximizing your Roth IRA every year and investing in dividend stocks, you are building completely tax-free income for retirement. Over decades, the tax savings are enormous. On a $1 million Roth IRA generating $40,000 in annual dividends, you save about $8,000 per year in taxes at a 20% rate. Over 20 years, that is $160,000 in tax savings. This compounds over time. The step up in cost basis at death is another huge tax advantage. Let me give you a detailed example. You buy 1,000 shares of Coca-Cola at $50 per share, 50,000 total. You hold for 30 years. The stock grows to 200 per share. Your 1,000 shares are now worth 200,000. You have 150,000 in unrealized capital gains. You never sold, so you never paid taxes on the gains. You die. Your children inherit the stock. Their cost basis is stepped up to the $200 market price at your death. They can immediately sell all 1,000 shares at $200 each and pay zero capital gains tax. Your 150,000 gain is never taxed. This is completely legal. This is how wealthy families transfer wealth tax-free. If your children hold the stock instead of selling, they only pay tax on appreciation above the 200 stepped-up basis. If the stock goes to 300, they pay tax on the 100 gain per share, not on the full 250 gain from your original purchase price. The step-up wipes out all your embedded gains. This creates massive tax savings on 150,000 in gains at a 20% capital gains rate. You save 30,000 in taxes. On a $1 million gain, you save 200,000 in taxes. This is why buy and hold dividend investing in taxable accounts is so powerful. You defer all taxes during your life and eliminate them at death. Let me give you one final detailed example of how to build a retirement income plan using these 5 dividend stocks. You are 40 years old. You earn $100,000 per year. You save $20,000 annually. You do this for 25 years until you are 65. You invest exclusively in these 5 stocks using my allocation. Starting yield is 3.6%. Dividend growth is 5.2%. Stock price appreciation is 4% annually. These are conservative assumptions below historical averages. After 25 years, you have contributed $500,000 of your own money. Your portfolio is worth $2.1 million. You retire at 65. You stop contributing. You stop reinvesting dividends. You start taking income. Your original 3.6% yield has grown at 5.2% annually for 25 years. Your yield on cost is now 12.4%. On $2.1 million, that is $260,000 per year in dividend income. $260,000 from a portfolio built on $20,000 per year savings. And this income is qualified dividends, taxed at 15%. After tax, you have $220,000, more than double your working income. And it grows 5.2% per year. After 10 years in retirement, you are 75. Your dividend income has grown to $429,000 per year. Your lifestyle has improved dramatically. Your principal is still $2.1 million or likely more because stock prices continued growing. You have not touched your principal. You have lived lavishly on dividends. You can leave your entire portfolio to your children. They inherit $2.1 million plus decades more of dividend growth. This is how you build generational wealth. This is not fantasy. This is math. This is what happens when you save consistently, invest in quality dividend stocks, reinvest dividends during accumulation, and live off the income in retirement. The compound growth is extraordinary. The income security is absolute. The legacy you leave is substantial. This is why I trust dividend stocks with my final $149 billion. And this is why you should build your own dividend portfolio starting today.